trillions of dollars are currently locked inside traditional fund structures, but right now, billions of those dollars are rapidly migrating into on-chain vaults. For decades, the legacy system has held on to that capital because it offers something highly desirable to institutional investors: comfortable, established legal wrappers and clear jurisdictional boundaries. But those legal wrappers come with severe operational friction. The traditional system relies on opaque, delayed reporting and manual settlement times that can trap capital in transit for days. On-chain vaults offer an alternative built entirely on programmatic efficiency, replacing human clerks with automated code. But doing so introduces bleeding-edge technological vulnerabilities. We are not going to debate the specific assets or trading strategies inside these funds. Instead, we are looking strictly at the plumbing that makes these two systems function. To evaluate these competing architectures, we will measure them across two specific vectors: settlement speed and operational transparency. This split-screen flowchart maps out the traditional financial pipeline. Capital moving from an investor to a strategy must pass through a broker, clearinghouse, and administrator. The on-chain alternative bypasses these intermediaries, creating a single, unbroken execution path directly into a smart contract vault. By moving asset management onto a blockchain, the basis of trust shifts entirely away from regulated human clerks and places the burden of execution squarely on cryptographic code. Traditional settlement is a heavily manual process. When an investor wants to redeem their shares, human administrators and centralized clearinghouses must physically process and verify the request. The primary benefit of putting humans in the loop is safety. If a trade fails or an input error occurs, there are established Webull safety nets and physical offices you can call to reverse the transaction. This comparison matrix highlights the massive trade-off for that legal safety: speed. The manual verification process forces a T+2 or T+3 settlement cycle, trapping the investor's liquidity in transit for days. The on-chain alternative handles deposits and redemptions using smart contract standards like ERC 4626 or ERC 7540. ERC 4626 is a framework that tokenizes yield-bearing vaults, while ERC 7540 extends that logic to handle asynchronous asset flows. These smart contracts eliminate back-office intervention. They enable instantaneous, programmatic settlement for digital tokens, or strict programmed T+1 settlement for physical assets. However, achieving that execution speed exposes the system's most critical vulnerability. Every transaction is completely immutable. If the contract is exploited or a manager makes a simple input error, there is no centralized authority to call. Without human intermediaries to freeze the ledger, capital recovery is highly unlikely and requires complex interventions. Adopting on-chain settlement means actively choosing to sacrifice legal reversibility and capital safety nets to achieve absolute capital efficiency. In traditional finance, managers report their performance using monthly fact sheets generated from internal, siloed databases. This legacy model gives the vault operator total control over their narrative. They dictate exactly what information is shared through carefully curated periodic updates. For the investor, this creates severe information asymmetry. They are forced to accept a black box risk with absolutely no real-time visibility into the actual underlying portfolio. Looking at the transparency row of our matrix, the on-chain model operates in total daylight. It continuously publishes the vault's net asset value, the total value of the vault's underlying assets minus its liabilities, and all fee distributions directly onto a public ledger. Investors gain a live transparency cockpit. They can track the exact performance of their capital, review historical drawdowns, and monitor fee extractions 24 hours a day. But for the vault operator, this creates a severe trade-off. Their precise trading strategy and asset allocations are entirely exposed to the public. Competitors and adversarial traders can analyze the open ledger in real time, allowing them to seamlessly copy the manager's playbook or front-run their operational moves. Radical on-chain transparency entirely solves the investor's black box problem, but it forces the manager to execute their strategy in full view of a highly predatory open market. Traditional fund governance relies on physical boards of directors and prime brokers to oversee asset movement and authorize large transfers. The on-chain replacement for the boardroom relies on multi-party computation wallets and access modifiers like Zodiac. Multi-party computation, or MPC, is a cryptographic system where multiple parties jointly authorize a transaction without revealing their individual private keys, while Zodiac is a toolkit that enforces specific execution rules. This section of our diagram illustrates how these tools create a cryptographically enforced segregation of duties inside the smart contract. For example, the valuation manager only has the cryptographic permission to propose a new NAV update. To actually execute it, the system strictly requires a secondary cryptographic signature from the curator to approve the data packet. This architecture makes it mathematically impossible for a single rogue employee or human actor to embezzle the vault's funds. However, replacing human oversight with cryptography creates immense logistical friction. Operators must securely manage multiple private keys and coordinate multi-signer approvals for every single execution. By stripping away the temptation of human corruption, managers inherit the unforgiving, zero-margin-for-error reality of strict cryptographic key security. Migrating to an on-chain vault is not a simple software upgrade. It is a total operational shift from relying on legal trust to relying on cryptographic trust. This quadrant chart maps these precise trade-offs against specific operational profiles, plotting an operator's tolerance for technical risk against their need for speed and transparency. In the bottom left, we have conservative institutions managing highly illiquid legacy assets. This profile should strictly remain in traditional fund structures. For them, public transparency is an active liability, and they absolutely require the safety net of legal trade reversibility. In the center of the quadrant are asset managers tokenizing real-world assets, digital tokens that represent physical instruments like real estate or treasury bills. Hybrid asynchronous vaults fit this profile perfectly. They utilize standards like Lagoon's ERC 7540 because they need on-chain transparency for their investors, but they still require off-chain, multi-day settlement times to actually liquidate physical assets. Finally, in the top right, we have crypto-native treasuries, DeFi protocols, and liquid token managers. These operators must use fully on-chain vaults. Their yield strategies depend entirely on real-time auto-compounding, instant programmable settlement, and total uninterrupted transparency for their liquidity providers. The best infrastructure choice depends entirely on what form of trust your limited partners value more: the familiar ink of an auditor's signature or the cold, immutable logic of a smart contract.